Hey guys, this is Julie. Good morning. Want to show you the power of these distributions and have you understand why it works. Primarily, the stock market, this is going to blow your mind, is 60% of institutional investors comprising of savings accounts, either the pension funds or the 401ks. Um, and so the market is always looking for a way for those funds to survive in a long environment, in an environment where the boomers are retiring, right? And so there's distribution currently in the market. Um, so first we have to, understand that the market is comprised of these normal distributions and the higher time frame bell curves. And if you can squint your eyes and pay attention to the ones, um, what the funds do is 68% of the time price is going to be trading inside the ones, right? So they buy their spreads inside these ones and they sell puts and sell calls on the outside of that. And they actually use the second standard deviation off of that, which is my end green lines on the bottom. And you can see that there was only one time that we had a bar close outside that area, one time only. Every other time, you're inside the ones and inside that second standard deviation. Every other time. And you can see this right here. So if you wonder where the market is going to stop, it's going to stop right there each time. Do you see that? Here, baby, yes, it did cross through it, but it closed back above it. They will break the market if they break the two right here, and we can get that. So we know where the market is. We have a big edge. We also know what the volatility is doing, whether it's going long or short, or currently falling or rising. Rising indicates range expansion. Falling indicates range contraction. The market will drift up in a range contraction, and it also can go long in a long ball also. But shorts typically only like that long ball. I say typically because we've experienced recently, I keep saying this like a broken record, um, some short trades on short ball. So with new market lows and very unusual. But the power of the second standard deviation is plainly clear, and I know where that level is. So I have a huge friggin' edge, right? As long as they're going to keep the market going the way that it's currently designed to work, we're going to be in good shape. And I think that we will always have a market that is supported. It makes sense to support the stock market versus allowing real estate assets to continue the appreciation ascent that's happening. They need to bring the real estate prices down to a more affordable, sustainable basis, and keep focusing on that 60% of the market comprised of the workers, whatever that number ends up being, they still need to support the market. So we can put higher time frame bell curves on our chart and see precisely where our levels are and know that anything above that generally is going to be long. Okay. Now, if we are falling in an environment where that one just keeps going down, 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 you trade to it, right? Trade to it, and then you can turn it around. Okay. So, I mean, you can trade up and down. You just need to know whether are you trading to the target or away from it. And I go by my trusty volatility slope. And I'm looking forward to working with a new volatility trader and maybe get some slope on some extended contracts to match with my real volatility levels because I think having the two combined together is going to be a very, very interesting, nice thing to do. That's what I think. All right. Thanks, guys. We'll talk to you soon.